I want to talk about China, not because they've got a pig shortage, we're going to get to that in a second, but because the Shenzhen index, kind of their NASDAQ, down 28% over a year. Their Shanghai composite, the main index, down 24% over a year. They're taking all these aggressive steps to try to help the economy. Do you think it will work? And do you think there are some investment opportunities around the Chinese market?
Yeah, we do. But it's important for U.S. investors to remember, first off, that Chinese equities are really dominated by those state-run companies that are large industrial firms. And we're in the middle of a global industrial production slowdown. So right now, it figures that China's market
That sounds like a good bear case for China.
Well, on the equity side, yes. But look at the services number that came out today. Still above 50, still showing growth there. Chinese consumers still spending money. We think that growth rate in China between 6 and 6.5% this year, pretty solid, pretty good growth for them, being driven by what's going on there. So the opportunities in China really are on that services side. If you can get in there, environmental services, financial services, all sorts of travel services, those sorts of things. So and also look for Chinese opportunities spilling over as they outsource into other countries in Southeast Asia and in India. For U.S. investors, we think the best play is a regional play.
Okay, so give us more into that. What are you recommending that Wells Fargo clients do?
So we want Wells Fargo clients and investors generally to be overweight emerging markets, and we like Asia very much. You got a great combination there with China on the industrial side, India on the services side, more and more technology coming into Southeast Asia. It's going to be, we think, an interesting and very diversified play going forward. So look for those opportunities for broad Asia exposure. Those are out there either in ETFs or in other vehicles.
Does that look better than the U.S. markets?
No, well, right now, yes. The answer is yes, just because they sold off by so much last year, and because we think there's more chop in the U.S. markets in the coming few weeks and even months.
Define chop.
Well, you know, you've had a nice rebound since the December 24th lows. How much further can that go? We think you're going to run into some resistance here.
Even though we had a good January, and of course the historical data says if January goes up, the market more likely than not will go up.
We do think the market goes up over the course of the year, not by as much as emerging, but we could have kind of a gray winter, let's put it that way, for the markets. It might be an opportunity to sell into rallies.
What's the weight? What's the drag?
The weight is still the ongoing industrial production slowdown that's global and has spilled over into the U.S. Political issues, we just saw that the president and the Speaker of the House still can't agree on the sort of the border funding. And frankly, you've still got issues going on with China.
How much are you watching the political landscape? How much should our viewers and listeners be watching the political landscape from a markets perspective?
Right, great question. The political landscape matters for the sentiment, which matters for how much volatility up and down you get in markets. But we still think the trajectory or the slope of the market is going to be higher for year end. So you're going to have a lot of up and down around the politics, but we think we finished the year higher around 2,800.
But overall, emerging Asia, perhaps India, parts of China, look more attractive
look
to
better
Wells
to us
Fargo.
right now, yeah.